We all like to have as much money as possible, don't we? So why not go the extra mile and multiply your money with proven techniques? A simple 9 to 5 isn't going to get you where you want to be regarding your finances if that's your plan. That is why you need to sit down and open up your investment portfolio. You need to invest money in the right places, which will bring you solid returns. Today, we will talk about 10 proven strategies that will double your savings in the year 2023. Interest-bearing accounts. If you want to minimize financial risk while increasing your wealth, consider exploring high-yield savings accounts and other interest-bearing options. Despite seemingly modest interest rates, it is achievable with patience, thanks to the power of compounding. Compounding interest, where your earned interest generates more over time, results in exponential growth. To estimate how long it will take to double your money, you can employ a simple formula known as the Rule of 72. The Rule of 72 is straightforward. Divide 72 by your annual rate of return. For instance, if your return is 2%, dividing 72 by 2 indicates that it would take approximately 35 years for your initial investment to double. While the Rule of 72 can be applied to investment vehicles, unlike interest-bearing accounts, investments are often subject to variable rates of return. This means you must select a rate based on historical performance or future projections, which introduces uncertainty and potential investment losses. It's worth noting that the Rule of 72 becomes less precise as rates of return increase, making it a more reliable tool for estimating the doubling time of your money when dealing with moderate or lower returns. Stock market. If you're considering doubling your savings, the thought of stocks has likely crossed your mind. Yet the path to achieving this financial goal is unclear to many. Numerous options beckon, but for amateur investors, opting for a diversified investment vehicle could be the right option. Consider allocating your funds to instruments like exchange-traded funds, ETFs, index funds, or mutual funds. These financial vehicles boast a broad spectrum of holdings, encompassing various companies and assets. Consequently, they exhibit a reduced level of risk, as the fortunes of individual entities may fluctuate differently within the fund. Many individuals need help with the difficulty of when to enter the market to maximize growth potential. However, an investment strategy known as dollar-cost averaging simplifies this dilemma. The principle is straightforward: invest a fixed sum at regular intervals, irrespective of market conditions. By doing so, you effectively average the market's peaks and troughs. Since the S&P 500, for instance, has historically generated an average annual return of 10.7%, adhering to this strategy can incrementally grow your wealth over time. Cryptocurrency. The fluctuation in the value of cryptocurrencies, be it Bitcoin, Ethereum, or Dogecoin, presents a potential avenue for speculators to profit through trading. Undoubtedly, this is a double-edged sword, as it equally opens the door to potential losses. Such risk is inherent when seeking rapid capital growth. Although several cryptocurrencies have witnessed meteoric rises in past years, they often exhibit substantial price swings, rendering it challenging to maintain positions during declines. Inadequate management of cryptocurrency holdings can lead to financial losses. It's worth noting that alternative methods for doubling your capital exist, which are simpler to execute and carry lower levels of risk. Get on with a side hustle. In its essence, investing denotes the act of allocating your resources to foster growth. This principle extends beyond financial products. It encompasses endeavors like investing in a business. Consider a scenario where you craft jewelry. A strategic investment of $1,000 in specialized equipment could significantly amplify your jewelry production capacity. Though this investment incurs an immediate $1,000 expense, introducing this machinery can potentially translate into substantial future earnings, yielding returns that far outweigh the initial outlay. Even if your schedule cannot accommodate the pursuit of a grand entrepreneurial venture, several side hustles are tailor-made for individuals with time constraints. To identify the ideal endeavor for your circumstances, begin by evaluating your skill set, determining the amount of time you can devote to your side venture, and assessing your initial financial investment capacity. Prioritizing side hustles that offer passive income opportunities may prove advantageous. A prime example of this is creating YouTube content, where you continuously earn revenue from your archived videos, allowing your earnings to accumulate over time without constant active input. Buy a home. Real estate may not initially strike one as a vehicle for achieving rapid wealth multiplication, often associated with its image of gradual, stable appreciation rather than explosive surges. However, a closer examination of real estate transactions, particularly those involving mortgages, reveals that investing in property can yield substantial gains and potentially double your initial investment. When acquiring a property, the key lies in leverage, commonly harnessed by home buyers. For example, purchasing a $200,000 home with a standard 20% down payment, amounting to $40,000, excluding closing costs and additional expenses. What percentage increase in your home's value is needed to double your investment? Just 20%. When your property appreciates to $240,000, you have recouped your initial $40,000 and garnered an additional $40,000 in capital gain, leading to a total profit of 100%. This illustrates the potency of leverage in real estate investments. Unlike other investment avenues, real estate demands ongoing financial commitments for maintenance, property taxes, and mortgage payments. Nevertheless, these expenditures are mitigated by the prospect of ownership, offering potential appreciation in property value, which contrasts favorably with the alternative of renting. Selling off your possessions. Statistical data suggests that the typical American household possesses approximately 300,000 possessions, implying that you probably have a collection of items with potential resale value within your grasp. Taking a step beyond decluttering, you can explore the world of item flipping, including the resale of thrift shop discoveries. This path offers a relatively straightforward means to double your initial investment, primarily because you already possess the essential prerequisites. The overhead required to commence this venture may be minimal, encompassing costs related to packaging materials and establishing an online presence. Platforms like Craigslist, eBay, Poshmark, and Vinted, or the more traditional route of organizing a yard sale, can serve as avenues to sell your items and double your capital. The beauty of this approach lies in its accessibility. You can leverage your existing possessions and possibly unearth hidden treasures elsewhere, translating into profit with relatively modest financial inputs. Whether you aim to declutter or actively engage in flipping, the potential to double your money awaits through the resale of items you may possess or uncover during your thrift shopping adventures. Pay off your debt. If your primary focus is increasing your income without addressing your outstanding debts, the interest expenses associated with your debts could erode any gains, possibly leading to a negative overall financial growth rate. In certain scenarios, eliminating debt can effectively double your financial standing. Consider a situation where you earn $2,000 monthly after taxes, but must allocate $1,000 of this income toward loan repayments. By liberating yourself from this debt burden, you would suddenly have $2,000 at your disposal each month, effectively doubling your available funds. Once you've successfully managed your debt, your cash flow will significantly improve, allowing you to redirect the money previously allocated to debt servicing toward investment opportunities, as discussed in the strategies above. This shift in financial strategy can pave the way for enhanced wealth accumulation and improved financial stability. Get a 401k. Many corporations provide an enticing incentive known as an employer match for 401k contributions, whereby your workplace augments your investments. When you factor in potential investment returns, this emerges as one of the most straightforward means to double your capital. The specifics of this matching arrangement can vary widely among employers. Some may opt to match only a portion of your contributions, for instance, by reaching 50% of the amount you invest in your 401k. In contrast, others may offer a more generous 100% match. Additional conditions and limitations might apply, such as capping the matching percentage at a fixed portion of your salary, often around 6%. To illustrate, imagine your employer extends a 100% match up to 10% of your earnings. If you earn $3,000 monthly and channel $300 each month into your 401k, your employer will contribute an additional $300, instantly doubling your money. When strategically utilized, this employer match feature can significantly enhance wealth accumulation prospects. Equities. Equities may appear intimidating at first glance, but with diligent research and careful selection, you can navigate this market wisely. The equity market has weathered significant challenges in the past. And while we briefly discussed the stock market earlier, it's worth delving into the broader category of equities. Equities stand apart due to their diverse range of forms available for purchase. Your trading platform typically offers a variety of options, including individual stocks, equity bonds, equity funds, and equity ETFs. The resilience of equities suggests a potential resurgence on the horizon. The rationale for dedicating a separate category to equities lies in their potential response to evolving economic trends. As inflation shows a modest uptick, it may trigger a market correction. While investing in equities may not propel you to the pinnacle of financial success, it can serve as a hedge against extreme downturns, providing an opportunity to multiply your investment capital. Mutual funds. Another surprising yet promising avenue for potential capital growth is the realm of mutual funds. But not all mutual funds are created equal. If your goal is to double your initial investment, you must venture into the right sectors and identify top-notch growth-oriented mutual funds to accomplish this feat. The choice you make should align with your specific objectives. Are you seeking robust returns and dividend income to double your capital? If so, your focus should be identifying high-yield funds that can provide substantial dividend payouts while targeting capital appreciation. On the other hand, if you aim to double your investment through capital growth, your quest should lead you towards growth-oriented funds that inspire confidence. Additionally, keep a keen eye on equity-based funds, particularly tailored to the current market conditions, as they can offer a pathway towards achieving your financial doubling goal. The key lies in aligning your mutual fund selections with your overarching investment objectives. Conclusion: all these proven methods will get you to your goal of doubling your money. It will take time and effort, but these methods will expand your investment portfolio. Use these methods to be on your way to financial freedom. We hope you liked the video. Make sure to subscribe to the channel and press the bell icon so you never miss any video in the future. See you next time.